It is Sunday, March 1st. Silver closed on Friday at 93.66, and right now the entire financial world is sitting in the dark, waiting for one thing, 6 p.m. Eastern, when Asia opens and the paper price finally has to react to war headlines and a physical market that has already moved. This is not a normal Sunday, and Wall Street is not planning to sit here politely and let silver gap straight to $100 without a fight. In this video, I'm going to walk you through exactly how the Sunday sabotage works, how CME and the clearinghouses change the rules hours before the open, what margin requirements really are, and how they're used as a weapon against small traders, why a forced paper crash at the open does not stop Chinese and global physical buyers from stepping in, and what that means for anyone trying to survive tonight's open with their sanity and their account intact. This is not financial advice. This is an explanation of how the game is actually played on the one night of the week when you're most exposed and least informed. Segment 1, the 6 p.m. deadline, why tonight matters. Let's start with the clock. It is Sunday, March 1st. Silver's last official COMEX print on Friday was 93.66, a historic close after weeks of war risk, COMEX delivery stress, and a physical market in China and India already paying way over Western spot. Since that close, Iran has turned into a war zone. The Strait of Hormuz has been threatened and effectively shut. Pakistan and Afghanistan have escalated into open conflict. Tokenized gold and physical silver in Asia have already repriced the risk while COMEX sits frozen. The one moment where all of this has to get reflected in your broker's app is 6 p.m. Eastern when Asian futures open. If you are short silver, short miners, or running any kind of leveraged inverse play on metals, you are staring at that open like it's a margin call countdown. If you are long silver, heavy in PSLV or physical, or just sitting on miners, you're thinking, let it gap. Let it show the real price. Wall Street is not emotionally invested in either side. It is structurally invested in one thing: no catastrophic blow-ups in the big institutions. And that is exactly where the Sunday sabotage comes in. Segment 2, why 93.66 terrifies Wall Street on paper. 93.66 is just a number. In context, it's a trap. Here's why that close is so dangerous for the short side. It sits right under a cluster of obvious psychological levels: $95, $100, $120. It comes after a week where silver already blew through $90 and then got managed back down with halts, slams, and aggressive selling. It's sitting in front of a weekend where every new headline pushes fair value up, not down. If silver opens in Asia and trades straight through $100, a few things happen very quickly. Every fund that was short above $90 is instantly underwater. VAR models that never contemplated a war gap of that size start flashing red. Clearinghouses see margin deficits at the member level, and calls go out, we need to get ahead of this before the screen opens. Because in a world where COMEX registered silver has been drained hard in the last 2 months, physical demand from China and India is strong, and trust in paper is already damaged. A straight gap to 100 plus is not just a price move, it's an invitation to a short squeeze, and clearinghouses do not like short squeezes when the shorts are big connected clients. So instead of waiting to see if the fuse burns all the way down, they do what the rulebook quietly allows them to do. They change the rules before the open. Segment 3, the Sunday sabotage, changing the rules mid-game. Let's talk about what changing the rules actually means on a night like this. The legal tool is boring. The timing is what makes it dirty. CME Group and the clearinghouses have the authority to raise margin requirements on futures contracts, change position limits, switch markets to liquidation only, or in extreme cases, halt trading or open with trading bans already in place. They justify this under risk management, systemic protection, ensuring an orderly market. All technically true. But look at how it's used in the real world. The circulars go out late Sunday, when retail is asleep, when smaller funds have skeleton crews, and when there is no time to raise cash or adjust positions before the open. The new margin tables say something like, silver futures initial margin up 40-60%, maintenance margin up accordingly. That means, if you were maxed at Friday's margin levels, you are now out of compliance before a single new tick has printed. What happens next is not discretionary, it's automatic. Segment 4, what margin requirements really are, and how they trap you. Let's strip the jargon. When you trade futures, like COMEX silver, you don't pay the full notional value of the contract. You post margin. 2 key numbers. Initial margin, the amount you need to open a position. Maintenance margin, the minimum you must keep in your account to hold that position. If you fall below maintenance, you get a margin call. Send more money. If you don't meet that call in time, your broker liquidates your position. They close your trade whether you like it or not. Now plug in what happens on a night like this. CME says, by the way, margin requirements are up 50% starting at tonight's open. Ori, you need to see students. You discover that your 5 silver contracts, which were fine on Friday, now need an extra X thousand dollars to remain compliant. You either don't see the email in time, don't have the cash, or your risk controls are automated. Then, the system doesn't wait for you to decide. It sells for you. If you're long, it dumps your longs into the opening print. If you're short, it may force buys if your account is in deficit. Most of the time, this game is tilted at high leverage longs. Retail traders trying to ride a rocket with minimal margin. But on a night like this, the target is more subtle. By jacking up margin across the board, they lower the maximum size anyone can carry into a short squeeze. Smaller players get flushed. Larger institutions who got an early warning can pre-fund or adjust ahead of the move. The end result? A wave of forced selling right into the open. The chart shows a mysterious red candle. Commentators say price rejected 100, when in reality, most of the selling was not opinion. It was forced. That is the Sunday sabotage. Use the rulebook to cause a liquidation before price discovery has a chance to be honest. Segment 5. Why this margin trap hits retail and small funds hardest. Let's be clear about who gets hurt when margin rules change on Sunday. If you are a big bank dealer, a Tier 1 hedge fund, or a clearing member, you. See the circulars first. Have direct lines to CME risk. Have 10 to 20 people watching this live around the clock. You can top up margin. Reduce risk into the close on Friday if you see it coming. Restructure exposure using OTC swaps instead of exchange futures. If you are a small CTA, a prop trader, a retail futures trader, you find out when your broker updates the margin table in your portal. Get an email warning buried in 1,000 other notifications. Don't have spare millions sitting in cash to top up margin instantly. So when new rules hit, they are a nudge to the big players. Heads up, game is changing. And a hammer to the small players. You're out, like it or not. By the time the dust settles, the public sees volatility and panic selling. The actual mechanism was a policy change, not a spontaneous change in sentiment. That's the dirty part. They didn't change your mind. They changed your ability to stay in the trade. Segment 6. Why this playbook fails against physical buyers. Now the good news, this works only in the paper world. There are 3 reasons the margin trap fails against physical buyers. No forced liquidations on metal in your hand. If you hold silver in a vault under your name, in your own safe, in a fully allocated structure, no one can. Send you a margin call. Force sell your bars. Close your position because CME changed a number. You might decide to sell. You might decide to hold. But it's your decision, not your broker's. Asia doesn't care about COMEX rule changes Chinese and global physical buyers see. War risk. Shenzhen buyback prices already at triple digits. Dealers unwilling to sell inventory at anything near Friday's COMEX print. When they see a paper dip engineered by Western margin rule changes, they don't interpret that as silver is worth less. They see someone just put metal on sale in a crisis. China doesn't care if CME raised margins on your US account. They care about how many ounces they can secure before the next shock. The structural deficits don't reset with one policy change. Raising margins does not. Create new mine supply. Refill COMEX registered inventory. Eliminate 6 years of structural deficits in the silver market. All it does is temporarily reduce speculative leverage, temporarily flatten a squeeze, temporarily scare weak hands out of the market. The underlying math, deficits, inventories, physical premiums, remains exactly the same. That's why every time they use the margin weapon, the effect gets weaker. More people learn the pattern. More capital moves to physical and unlevered exposure. Segment 7. What tonight's sabotage might look like on the chart. Let's be specific about what you might see on your screen tonight. Version A. The clean sabotage CME raises silver margins aggressively before the open. Retail and small funds get auto-liquidated or manually panic close. Asia opens, and instead of gapping from $93 to 100 plus, silver spikes up a bit, then sells off into the mid-80s on heavy volume. The headlines tomorrow: silver rally fizzles. War premium already priced in. Traders take profits. Reality: forced liquidations, not informed selling. If physical demand is as strong as Shenzhen and Shanghai suggest, that dip will be bought. The wick on that candle will be long. The close may be much higher than the low. Version B, the failed sabotage. They raise margins. There is some forced selling, but the buy orders are larger than the margin dump. On the chart, you see a quick red push at the open, then an immediate reversal. Silver rips through $100 anyway. Shorts who thought the exchange has my back suddenly realize the exchange can slow gravity, but it cannot turn off the war or conjure new metal. In either case, remember, the first hour tonight is not a referendum on silver's long-term value. It's a referendum on how much leverage was in the system at the worst possible time. Segment 8, how to protect yourself before and during the open. I can't give you advice, but I can give you a framework. Before the open, know your leverage. If your entire position depends on margin not going up and price not gapping against you, you are not investing, you are gambling on policy. Know what you actually own. Futures, you can be forced flat. ETFs, they can gap, halt, or trade at discounts. Physical, it doesn't move unless you move it. During the open, don't let the first 5-minute candle rewrite your entire macro thesis. Watch where silver trades relative to Friday's 90th rise 66, how deep any engineered dip is, whether that dip is immediately bought or not. Pay attention to physical indicators over the next 24-48 hours. Shanghai and Shenzhen prices, dealer premiums and availability. Any new COMEX warehouse data on registered versus total stocks. Remember, the system is doing everything it can to protect large short players and the clearinghouse from a disorderly squeeze. The metal is doing everything it can to clear at a fair price in a world that just got more dangerous. Your job is to decide which one you trust. Segment 9. The bigger lesson of every Sunday sabotage. Every time Wall Street plays this game, it teaches the same lesson. In a crisis, they will not hesitate to change the rules. They will not wait for a democratic vote from the market. They will pull every lever to keep the house solvent. If you treat futures as a trading tool, fine. Use them, but understand the house edge. Treat them as owning silver. You are kidding yourself. The only positions that cannot be changed by a Sunday circular are fully paid, unlevered, owned assets, especially those that sit outside the exchange infrastructure. That's why in every silver panic, you see the same thing. Futures first, ETFs second, physical last. Tonight will be no different. Wall Street will spring the Sunday sabotage because that's the only tool it has that works while markets are closed. China will buy the dip because that's the only rational response when you need real metal in a real war. And when you wake up tomorrow and see the chart, you'll know exactly what you're looking at. Not just red or green, not just fear or greed, but the footprints of a system that cannot afford to let silver trade freely and a physical market that's slowly slipping out of its control.